Hi, I'm John Mayfield, the Real Estate Tech Guy, with another Global Real Estate School podcast. Welcome to the podcast. My name is John Mayfield, the Real Estate Tech Guy, and this is another episode talking about financial terms, financial terminology. On the last few podcasts, we have been talking about some of the different types of mortgages that consumers can get. And today we're going to talk about an adjustable rate mortgage. That's right, an adjustable rate mortgage. These mortgages were quite popular back in the 1980s. They're still popular today, although interest rates have been so low today that, of course, many people want to get a fixed interest rate. And fixed interest rates are good. There's no, it's great to lock in at a low interest rate. However, sometimes when you look at all the fine print and details about different types of mortgages, fixed interest rates sometimes can incur some higher cost. We talk about discount points in the course and loan origination fees, and a discount point is 1% of the loan amount. Always figure your discount points on the loan amount, not the sales price. And so adjustable rate mortgages, because the lender has the flexibility to lower the interest rate or raise the interest rate depending on the economic environment, sometimes the cost involved with an adjustable rate mortgage are much lower than a fixed interest rate mortgage. Therefore, if you were planning to relocate in 1 or 2 years, or if you were just taking your mortgage out for a short period of time, you might really come out on the better end by taking an adjustable rate mortgage, because when you factor in your discount points and other types of fees that a fixed rate mortgage provides, in the long term or in that short term period, you actually might be paying more interest than taking an adjustable rate mortgage, because that's another benefit of an adjustable rate mortgage. The interest rate's normally going to be much lower. So let's talk about an adjustable rate mortgage. It's not always a bad type of loan. If you were going to be in your home and you know that I'm only going to be there for 1 year or 2 years, and then I'm relocating back to where I was, or my kids are going to be in college and I'm just getting a loan so they will be in the home while they are away at school, but once they graduate, I'm selling that property, you might actually want to consider an adjustable rate mortgage. Again, lower interest rate and less closing cost. The only way to find out is to ask the lender, compare, and shop. But with an adjustable rate mortgage for the real estate examination, you understand that the interest rate can adjust, just like it says. It's an adjustable rate mortgage. Interest could go up or down. And so there are a couple of key features that are normally associated with an adjustable rate mortgage. First of all, you will have what's called an adjustment period, or is it a 3-year adjustable rate mortgage or a 5-year adjustable rate mortgage? It could be 1, 2, 7, just depends. And so that interest rate will adjust depending on the adjustment rate period that you take. So if you take a 4% adjustable rate mortgage and it's a 2-year adjustable rate mortgage, in 2 years, the interest rate is going to either go up or down depending on what's happening in the local or the national economic environment. So we have an adjustable rate period. Pretty easy to figure that out. We also have a thing called a margin, and the margin is going to be associated with some type of an index. For example, you have a 2-year adjustable rate mortgage, as we just discussed, 4% interest rate. In 2 years, they will adjust your mortgage interest rate either up or down. They normally will look at that index and then they will add the margin to the index. And depending on where that falls, yes, it's kind of like, I guess, gambling in Las Vegas, wherever the chips fall, that's where your new interest rate will be. So let's go back to our 4% interest rate. 2-year adjustable rate mortgage. You started out at 4% interest rate. 2 years goes by, and they will look at the index. Again, it's another key part of that adjustable rate mortgage. So let's just say they're looking at Treasury bills, and Treasury bills are 3%. And then they add the margin to the Treasury bill. And the margin's normally going to be 2.25, 2.5. They will add that. So let's say it's 2.5. Treasury bill index that they're using is 3%. Together, that's 5.5% interest, correct? You have a 3% Treasury index bill and a 2.5 margin. So when you add the 2.5 onto to the 3% index, you get 5.5% as the new number. That's where the chips fall. So guess what your new interest rate is for the next 2 years? Because remember, it's an adjustable rate mortgage. Well, your interest rate will be 5.5%. Now, normally, most adjustable rate mortgages will have what they call caps. So maybe you have a 2% cap, which says we will never raise it more than 2% per adjustment period. That would be, on your 4, would be 6%. Well, they would raise your rate to 5.5% because it falls underneath that cap. So you have caps per adjustment period, and you normally have a lifetime cap. That could be 5 or 6%. Again, every lender's a little different. You have to look at the fine print. You have to ask questions. But if it's a 5% lifetime cap, the highest your interest rate could ever go would be 9%. Now, in 2 more years, they will look at the Treasury index. Let's say it's dropped down to 1%. And by the way, I have no idea what the T-bills are. They're going to tie it to some index. But let's just say this index they tie it to is dropped down to 1%. Well, you have a 2.5% margin. They will add that onto the 1%. That is what? 3.5%. So now your interest rate's going to actually drop 2 percentage points because you have a 2% cap, adjustment cap. And so now your interest rate will be 3.5% for the next 2 years. Kind of see how that goes. So you have an adjustment period. Is it a adjustable rate mortgage for 2 years, 3 years, 5 years, 7 years. You have an index, you have a margin. The margin is going to be added to the index. You can have adjustable rate caps per adjustment, 2% cap per adjustment, and you have a lifetime cap. Maybe it's 5% lifetime. You can also have on an adjustable rate mortgage what we call a payment cap. So the payment can cap out at a certain rate, and that's kind of built in so that going in your payment will not go to a level you do not want to see it go to. Now, the problem with payment caps is what we call negative amortization, and I'm going to talk about that on our next podcast. Well, as always, I want to thank you for listening to the podcast. Don't forget, we have some great tools at our website. I'm hearing from students from Seattle, Washington, New Mexico, New York, all over the United States, and that is so cool. And they are purchasing our digital flashcards, our practice exams, because we can help you on that national part of the real estate examination. So check us out. It's globalrealestateschool.com. We can help you regardless of what state you are located in. We are approved in 4 different states: Oklahoma, Kansas, South Dakota, and Missouri. So if you want to get your license in any of those 4 states, check us out, globalrealestateschool.com. But if you are not in one of those states and you are in school right now and you need some study material or some study aids, we want you to subscribe at globalrealestateschool.com for some of our study aids, and check us out for our live streaming at helpmepasstherealestateexam.com. As always, thanks again for listening. I hope you have a great day. Thank you for listening to the podcast for Global Real Estate School. I'm John Mayfield, the Real Estate Tech Guy. Go out and make it a great day.